Hi, everyone. I'm Neil Gilfedder, Chief Investment Officer at Edelman Financial Engines. I'm joined with Katie Klingensmith, our Chief Investment Strategist. Hi, Katie. It's been quite a week in markets. What's been going on?
It really has been quite a week, especially after Wednesday when the Trump administration made the announcements about reciprocal tariffs, around tariffs of 10% levied against all the countries in the world and much higher levels against certain countries. I mean, we all knew this day was coming, and markets actually were kind of positive going into it, but the level of tariffs that were announced Wednesday afternoon was higher than a lot of people anticipated. So now we're really looking at the political fallout, but also the market fallout. And on that note, I was hoping you could walk us through what's happened and what you think will happen in markets.
Certainly. So, right after the announcement, the next 2 days, Thursday and Friday, US equities were down sharply on both days. But around the world, things were a little different. International markets were down as well, but they weren't down as much. And US Treasury bonds, which are traditionally viewed as a safe haven where people move during times of market uncertainty, rose. So it's been a negative picture, but a less negative picture than if you looked at US markets alone. And going forward, there's a lot of uncertainty remaining. Part of that uncertainty is how other countries are going to react. We've seen China react pretty aggressively in increasing its tariffs on US goods. Europe is making noises about being strong in its reaction too. On the other hand, you've had negotiations with countries like Vietnam suggesting that this may be partly about negotiating. So markets are not sure what the end game is. And until this resolves, and it's as much a political question as an economic one, markets are probably going to bounce around for a while.
Yeah, I think it's interesting. Last week, we were all trying to understand what this news means. And we heard from Jerome Powell, the chair of the Fed, really reflect the same thing, that he expected tariffs. And he certainly is saying, like a lot of economists, that tariffs are likely to bring higher inflation and real headwinds for economic growth. But now that the tariffs do seem to be higher than we and he expected, it could be a lot harder for the Fed to orchestrate that soft landing. And certainly, Chairman Powell is telling us that they're not sure what they'll do at the FOMC. And so interest rate cuts, interest rates staying steady for longer, all of that is back on the table.
So, Katie, are we in a recession yet?
It's interesting, Neil. Recession is two consecutive quarters of contraction of the US GDP shrinking. And really, all of the data we get is backwards looking. It's about what's already happened. We just got some data last week that usually is what everyone focuses on. The health of the labor market was pretty good. It was better than expected. So we're not in recession yet. But now, with the amount of uncertainty, not just in financial markets, but for businesses and individuals, it's really hard to make decisions. It's hard to invest. It's hard to hire new people. So the probabilities of recession certainly have gone up. And the questions around that outlook are going to be really, really with us for a while until all of this tariff back and forth is more settled.
Right.
And I think, on that note, even if we're not in recession yet, these questions still, we have to answer them in the near term about how we manage our own money. Neil, I'm hoping that you can help give us some insights around what's happening in the portfolios of our clients at Element Financial Engines.
Yeah, sure. Our portfolio managers are looking at them, constantly. We're always keeping an eye on them. And a couple of things to bear in mind. First thing is our portfolio is designed to perform well over the long term. Right? Investing involves taking risk. There will be bumps along the way. What we're doing, though, is to make sure that the portfolios are diversified. That means, as I mentioned earlier, that not all asset classes are doing as badly as each other at the moment. We have exposure to bonds. That's going to cushion your portfolio somewhat. You have international equities as well. So we're making sure that that diversification remains tuned up, which means when we check portfolios to see if they've drifted, we're going to be sure to bring them back to where they need to be to be best positioned to help you hit your goals. So the team's really on that. So we're looking, updating our market data, looking at portfolios, making sure that we trade them when necessary in order to tune them up and make sure that they're set to do what they're meant to do.
And I know last year everybody wished they were only in the S&P 500, and it was hard to really make the case for having that diversification. Can you just explain to us why it's so important to stay invested?
Yeah, I mean, one of the things is that when an asset class is doing really well, the temptation is to jump all in on that. Things, as we've seen, can turn, and they can turn pretty quickly, which is why you want to, make sure you're diversified. A second thing is about staying invested. As I said, there's uncertainty in the future. I think it's going to be a bumpy for a while as things play out. When markets fall off and there's volatility, it's often at those times that you see markets have big up days as well. And if you look at a past quarter century of data on global equity markets, what you'll see is if you miss the top 25 best days over that quarter century, just 25 days, if you miss those, you would knock about 5 percentage points off your annual return. So it's impossible to predict when those positive days are going to come, but they tend to come at times when markets are at their most unsettled. So sure, if you've had a crystal ball and were able to get out 2 days before, that would have been great. But where we are now, it's when you want to stay, I think, invested, because if you don't, you risk locking in your losses and missing out on the gains as markets recover, as they tend to in the long term.
I know it's hard for me, and I think it's hard for a lot of people to not be emotional. And it's reassuring to think that portfolios really are built for many different seasons and for the long term. Neil, I want to thank you for talking with me today and thank all of our clients for trusting us at Edelman Financial Engines.
Thank you.